Qualifying for a mortgage is somewhat of a mystery to a lot of people, and they don't understand what lenders actually look at to see if you're qualified for a mortgage. So I'm going to break down the 5 things that lenders look at to see if you're qualified to buy a home. Number one is going to be your income, which is pretty self-explanatory. We want to see that you have consistent income, and typically that's over a 2-year period. So we want to see that it's consistent and it's not decreasing, whether that's a salary, commission, or bonus income. Salary is a little more straightforward, where if you have an offer letter from a new employer, or we just see that you make a standard salary, it's pretty straightforward, and that's going to be what is considered when we calculate what your income is. Now, commission comes with a little bit more layers to it, so we need to see that your commission income is either steady or increasing over time. So if you've had a big decrease in your commission income, we'll either need a good explanation of why that's decreasing, or we won't be able to count some of that commission income. Same thing with bonus income. We'll need to see that you're receiving a consistent bonus over the last 2 years, and it's pretty comparable in terms of the amount that you're getting year over year. The next thing is going to be your credit, and that's both your credit history and your credit score. So you want to make sure that your credit score is in qualifying range for whatever product you're applying for, whether that's FHA, conventional, VA, which is a little bit more lenient on the credit score side of things. Of course, that's factored in when we are looking at your file. Now, credit history also comes into play. So if you have a lot of mortgage lates or credit card lates, those start to pile up and can decrease your likelihood of getting your qualification in line. Number 3 is going to be your debt to income ratio. This is very simply put. It is the amount of money that you have coming in on a monthly basis versus the amount of money that you have going out on a monthly basis. This is anything that shows up on your credit. So if you have bills like groceries, utilities, things of that nature, those aren't going to be reflected on your credit, but things like credit cards, car loans, personal loans, those will all be reflected on your credit. So what we actually take into account is the monthly required payment for that credit line. So if you have a credit card with $1,000 on it and your minimum monthly payment is $50, that's what's going to be counted in your debt to income ratio. Now, when you're applying for a mortgage, we also factor in what your anticipated mortgage payment is. So that debt to income ratio typically needs to be below 50%. And what that means is whatever your gross monthly income is coming in, you need to have debt going out that is less than half of that or up to half of that. Different loan products can have a little bit more leniency on your debt to income ratio, such as FHA allows for a little bit over 50, but it's kind of a layered risk. So if you have a higher credit score, they might be a little bit more lenient on what your debt to income ratio is. All that means is when we're looking at your debt to income ratio, that gives us a good understanding of how much home or what monthly payment actually you can qualify for. Because if there's an HOA that's $250, that's going to be $250 extra dollars on your monthly payment. So we actually approve you for a monthly mortgage payment. So we can adjust that based on how much your income is, so we can really figure out how much home you can qualify for. Number 4 is going to be assets. So you'll need a down payment, cash to close, closing costs, all of that is wrapped into how much we need to see in your assets. Now, you can factor in retirement funds. Gift funds are also an option. So if you have a family member or someone who's willing to contribute money to help you buy a home, that's always an option to look at if you are so lucky to have that in your corner. Number 5, and this one is a little bit more high level, but it's just the overall credit risk. So all the things that we just talked about, those 4 items, it's really a layered risk. So if you have poor credit score, plus you have some mortgage lates, not a lot of assets, all of that is going to pile up, and we may not get an approval on that loan in that case. But if you have a really strong credit score and maybe you have a mortgage late on there, they might be willing to accept that risk because otherwise you have a pretty strong profile overall. The key here is with all of these different things that we look at, it's important to talk to a lender as soon as possible so we can look at if you have anything that you need to work on to get in line before you qualify. So if you're a year out from buying a home, talking to a lender now may be very beneficial to you so that we can work on anything we need to work on in the meantime, whether that's saving up assets or getting your credit score in place. A good lender will coach you and tell you what you need to work on in order to be in qualifying range. If you have any questions or want to have a conversation, my link is below and you can schedule time with me and we'll talk about how we can get you to qualify for your dream home.